Bill Dudley, my next guest, says recession is now inevitable. He joins me now, former president of the Federal Reserve Bank of New York. Bill, it is good to see you, sir. Look, this inevitability of recession, is this because the rate of interest rate increase is that you're expecting from the Fed over the rest of this year, basically half a point here, half a point there, is going to slow down to such an extent?
The problem is that when the Fed needs to tighten monetary policy sufficiently to push the unemployment rate up, in other words, the labor market is too tight today. In the past, whenever they had to push the unemployment rate up, they have not been able to achieve a soft landing. Chair Powell cited 3 episodes where the Fed has tightened and the economy did not go into recession. In all 3 of those circumstances, the unemployment rate kept falling during the tightening cycle. Fed can't allow the unemployment rate to keep falling. The labor market's already too tight. So the Fed has to cause the labor market to loosen. Now, this is going to happen very soon, right? Because monetary policy is still very, very accommodative. So we're not talking about a recession in the very near term. We're talking about a recession when the Fed makes monetary policy tight.
Right. But that means we've got a year or so. I mean, the first forecast came out from Deutsche, which was threatening or forecasting a recession back end of 23. That means a year to 18 months of this anomie, of this no man's land, as monetary policy gets tighter, and we don't sort of see the ship turn yet.
Yeah, the Fed's going to go for a soft landing, obviously. They're going to try to tighten enough to slow the economy down and keep inflation in check. The problem is, historically, they almost always overdo it. And I think that's probably what will happen this time. How quickly they turn to make monetary policy tight, though, is still uncertain. If you look at their forecasts, their own projections, they have monetary policy just slightly north of neutral, by the middle of 2023. So a lot of this also depends on the Fed's appetite to make monetary policy tight. And that probably depends on how fast inflation comes down over the next 6 to 12 months.
And if we look at your other, if you like, quote de jour, which is doing the rounds, the one about the markets, Bill Dudley, market says Fed might need to force stocks to fall. This is the same idea, isn't it? Rates go up so high that corporate profitability falls, and therefore PEs can't be justified.
This is not just my idea. This is Chair Powell's idea. He's made it very clear that monetary policy works through financial conditions. The Fed needs to make financial conditions tighter. One aspect of tighter financial conditions is weaker stock prices.
Is this, even absent Ukraine, is this a massive failure of Fed management of the policy rate when they should have been raising last year? They should have realized, when we were hearing all about this temporary inflation, this, that, and the other, and people were warning, no, you're wrong. It's not temporary, it is sticking.
Well, I think there's no question that the Federal Reserve is late, and this is really due to a couple decisions that they made. The first decision was to say that we're not going to even begin to tighten monetary policy until we reach 2% inflation, and we're confident that the economy is at full employment. They could have started to tighten before the economy reached full employment. They waited. The second thing that they did was they made some pretty bad forecasts. As you allude to, inflation turned out to be higher for much higher for much longer than they anticipated. And one of the consequences of that is it wasn't just the transitory price pressures. Those transitory price pressures have gone on long enough now that they're getting into wages. So wage gains of 5.5%, 6% are not consistent with 2% inflation. So the Fed has a problem. The economy has gone, it's almost too much of a good thing. The labor market's too tight. And now the Federal Reserve has to respond to make the U.S. labor market less tight. And that's very difficult to pull off.
At what point does the Fed have to accommodate, or at least to be aware of asset prices? I mean, the traditional view is, I see no evil, I hear no evil, we are only our mandate, etc., etc. But if the market falls further, faster, then surely that in itself has a wealth effect, a dampening wealth effect.
That's what they want. They want tighter financial conditions. So as long as the decline in, the tightening of financial conditions is, modest and not abrupt, they're actually going to be happy. They actually want to see the stock market a little bit lower, bond yields a little bit higher. Now, obviously, if the stock market were to collapse, we're talking about a 30, 40, 50% decline in the stock market, that would cause them to rethink, are we happy with how things are unfolding? But the so-called Fed put for the stock market is way lower than the current level of the equity market.
This doesn't bode well.
It doesn't bode well. I mean, for the markets. I mean, we've had an extraordinary, decade of very high financial asset returns. I think we're about to enter a decade where the financial asset returns are significantly lower.
Good to see you, Mr. President.